Hi everyone, welcome to a new video on Canadian investments. In this video, I will be discussing about RRSP. Most of you, in fact all of you who has been part of Canadian dividend investment community, the well-trained account holders, or who has been investing in stocks and funds would know what an RRSP is. So this video would be for the beginners, the people who have just started earning, new Canadians, or the ones who have never invested before. I will keep this video as simple as possible, and if you have any questions, please post that in the comment section. I can try to answer that, or anyone who is watching this video, feel free to respond. Okay, so let's go ahead and dive into the topic. What is an RRSP? An RRSP is a retirement saving plan to which you or your spouse or common law partner can contribute. RRSPs were introduced in 1957 by the federal government to help Canadians save for retirement. You can set up a registered retirement savings plan through a financial institution such as bank, credit union, trust, or an insurance company. RRSP investments can be a cash, individual stocks, GICs, bonds, mutual funds, ETF, etc., or a combination of any of these. The deductible RRSP contributions can be used to reduce your tax. So any money put into an RRSP up to the contribution limit can reduce your taxable incomes for that year. So for example, if your taxable income is $100,000 and you put $10,000 into RRSP, then your taxable income would be now only $90,000. So straight away you save the tax for that $10,000 from your taxable income. Any income you earn in the RRSP is usually exempt from tax as long as the funds remain in the plan. You generally have to pay tax when you receive payments from the plan. So we can say that contributions you make to an RRSP are tax deferred. But note that most withdrawals from RRSP are taxed as income when they are withdrawn. You can contribute to an RRSP as long as you have an income to report, to max of December 31st of the year you turn 71. What is a contribution limit and how is it calculated? We know that RRSP can reduce your taxable income for that year. So there will be a limit on how much money you can put into RRSP. You just can't put all your money into RRSP and pay no taxes at all. This limit is called the contribution limit. The RRSP contribution limit is the maximum amount a taxpayer is allowed to deposit into an RRSP annually. The contribution limit is unique to you. Your yearly contribution limit is a percentage of your earned income plus unused room from the earlier years. Your RRSP contribution limit is calculated each year and will appear on the notice of assessment you receive from CRA. The deadline for contributing to RRSP for a year would be the March 1st of next year. Say for tax year 2020, deadline would be March 1st, 2021. But instead of waiting for the deadline, best approach would be to contribute a small amount systematically throughout the year so that you can ride the wave of market fluctuations. But do keep a track of the total amount you invest per year so that you don't go over the limit. Deduction limit is the limit set by the government per year, or the 18% of your previous year's earned income. For 2021, you are allowed to contribute the lesser of $27,830 or 18% of your earned income for the previous year. Whereas for year 2020, the max was $27,230. Here is the limit for each year. As you can see, the limit amount increases annually. For example, if John earned $80,000 in 2019, his RRSP deduction limit is 18% of that amount. This is less than the maximum deduction limit. But if he has earned 180,000, his deduction limit would have been capped at the maximum limit of 27,230, as this is less than the 18% of his income. Now, this is for the current year alone. What about the previous year's limit? So let's look at the example of John again. Let's say John started working in 2017. He earned $70,000 in 2017. But since this is the first year, he does not qualify to contribute for RRSP. Remember, RRSP limit for current year is based on the last year's income. Once the tax is filed for 2017, on his notice of assessment, the RRSP limit for 2018 would appear. In this case, it would be 18% of 70,000. That is $12,600. As per the chart, the max for 2018 is 26,230, and since his 18% is less than the max, the 18% is considered as the contribution limit. Now, say for 2018 as well, he earned the income of 75,000. But for that year, even though he can contribute 12,600, let's say he only contributed 8,000 to RRSP. So for the year 2019, he would have the contribution limit of 13,500, that is 18% of 75,000, plus 4,600, the unused RRSP limit from 2018. So contribution limit would be the sum of your current year deduction limit plus any carry forward from your previous years. If you always max out the RRSP contributions, then your deduction limit will always be same as your contribution limit. But you don't have to worry about that or do the math using a calculator. The CRA in notice of assessment will provide the maximum amount of RRSP that you can contribute for the next financial year. Remember to use the limit for the year that you are filing taxes rather than the current year's limit. What happens if you go over your RRSP deduction limit? If you or your employer, in case of PRPP, Pooled Registered Pension Plan, contributes more to your RRSP or PRPP, or your spouse or common law partner's RRSP than your RRSP deduction limit allows, you will have an excess contribution. You are allowed to cumulatively over-contribute up to $2,000 to an RRSP without penalty, although you won't receive a tax deduction for the excess amount of that $2,000. Over $2,000, you have to pay a tax of 1% per month on any excess contribution that exceeds your RRSP PRPP deduction limit by more than $2,000. Unless you withdraw the excess amount right away and send a letter to the CRA explaining that it was a legitimate mistake, you may be able to obtain a waiver. Or the other option is move this amount to a qualified group plan. Now let's see how one can withdraw funds from RRSP. Is able to withdraw dollars or assets from an RRSP at any age. When you withdraw funds from an RRSP, your financial institutions withholds the tax. The rates depends on your residency and the amount you withdraw. For residents of Canada, the rates are 10% on amounts up to 5,000, 20% on amounts over 5,000 up to including 15,000, 30% on amount over 15,000. This percentage varies for people who are in Quebec. For funds held in province of Quebec, there will also be a provincial tax withheld. This will be additional 16%. If you are a non-resident of Canada, you will pay 25% tax withholding regardless of the size of the withdrawal. But the tax don't end there. The amount of the withdrawal is also included in your taxable income for that year. So if your marginal tax rate, the marginal tax rate is the amount of additional tax paid for every additional dollar received as income. So if your marginal tax rate is higher than the withholding tax rate, you will have to pay additional tax at the year end on the funds you have withdrawn. If not, then the remaining portion of the tax withhold will be returned back as refund. There are multiple ways you can actually withdraw the amount. 1. Take a lump sum. You can take a lump sum amount from your RRSP, either a portion or the complete amount. You have to pay a withholding tax based on the amount you have withdrawn. In addition to that, the withdrawn amount is added to that year's taxable income. So, additional tax has to be paid if the total tax for the taxable income is above the tax withholded. So, if you're already earning an income that year, then withdrawing the money from RRSP should be your last option. Let's say if you don't have a job and you don't have any income to report, then whatever money you have withdrawn would be your taxable income. In that case, the income tax for that year may be less than the RRSP withholding tax. So you may get a refund back. In any case, before you plan to withdraw from RRSP, it will be a wise decision to talk with your financial institution or your advisor. Second option, purchase an annuity. Similar to a pension, annuities will provide steady payout over an extended period of time. You can get one for a fixed term or for the rest of your life. Purchasing annuities are not subject to withholding tax. However, you may have to pay tax on the income you receive from annuity payments. In exchange for a single deposit, you will receive guaranteed income for life, just like a pension. Convert to a registered retirement income fund or RRIF. This is a retirement scheme where you'll have to withdraw a minimum portion of your savings each year, while the rest continues to grow. For RRIF, there is a minimum amount that you had to withdraw, but no maximum. Unless you cash out more than the minimum, there is no withholding tax. But the amount that you withdraw still goes into your taxable income for that year. Another important factor to note about RRIF is that it is mainly aimed for your retirement. So the minimum amount you can withdraw without incurring the withholding tax increases based on your age. So for example, the minimum money you can withdraw at the age of 75 is much higher than that of age 60. Do you know what happens when you withdraw funds from an RRSP? You permanently lose the contribution room you originally used to make your deposit. There are two better ways you can withdraw money without any withholding tax or the withdrawal getting added to your income. These are home buyer's plan. An RRSP holder can borrow tax-free up to 35,000, 70,000 for couples for buying a home. This loan has to be repaid within 15 years after 2 years of grace. Any missed payments get taxed as income. Contrary to popular belief, this plan can be used more than once per lifetime. As long as the borrower did not own a residence in the previous 5 years and has fully repaid any previous loan under this plan. Lifelong Learning Plan. The Lifelong Learning Plan allows for temporary diversions of tax-free funds from an RRSP. This program allows individuals to borrow from an RRSP to go or return to post-secondary school. The user may withdraw up to $10,000 per year or a maximum of $20,000. The first repayment under the LPP will be due at the earliest of the following two dates. 1. 60 days after the 5th year following the first withdrawal, or the second year after the last year the student was enrolled in full-time studies. Now let's look at a variant to an RRSP called Spousal RRSP. Contributes to your common law or married spouse RRSP can help build your partner's retirement basket. At the same time, you can lower the amount of tax that you pay together. This type of plan can help ensure that retirement income is more evenly split between both of you. The benefit is greatest if a higher income spouse or common law partner contributes to an RRSP for a lower income spouse or common law partner. The contributor receives the short-term benefit of the tax deduction for the contribution, and the annuitant, who is likely to be in a lower tax bracket during retirement, receives the income and reports it on their income tax and benefits return. Whether you contribute to your own RRSP or to a spousal RRSP, your contribution counts against your own RRSP deduction limit. It is important to note that spousal RRSPs are subject to a number of rules. Please do check those details before opening one. But note that after you made a spousal RRSP contribution, the money belongs to your spouse. They control the account, and when the money is withdrawn, it's also taxed as their income. However, if funds are withdrawn within 3 years of the contribution being made, the contributor, not the annuitant, will be taxed. This is known as the attribution rule, section 146 8.3 of the Federal Income Tax Act. Let's look at the example of Megan and Harry. For each of the past 5 years, Harry has been contributing $10,000 to Megan's spousal RRSP, maximizing his RRSP contribution room each year. His most recent contribution was in February 2020, which for tax purposes he deducted against his prior year's income. Later in 2020, requiring cash to fund an unexpected emergency, Megan withdrew $40,000 from her spousal RRSP. Because Harry had contributed to the spousal plan in the current and previous 2-year period, Megan's withdrawal triggered the attribution rule, resulting in $30,000 being taxed to Harry, $10,000 for each of 2029 and 2018. The remaining $10,000 was taxed to Megan. If you are over 71, you cannot put money into your RRSP account. But if your spouse is younger than you, you can still add it to the spousal RRSP. So we can conclude that RRSP is a great tool for Canadians to save for retirement. It's a good way to save tax now and a source of income when you retire. Even if it is a long way for you for the retirement, having an RRSP at a younger age is a good investment decision. Another advantage of starting RRSP early is that you can use the RRSP investment as a tax-free for the down payment of your home. I hope this video has helped you in understanding more about RRSPs and its benefits. If yes, I would appreciate if you can like this video and share it with your friends. If you are new here, please subscribe to my channel. I will be making a similar video on TFSA next, and further add more videos as a series of beginner investment guide. Thanks for watching. Take care.